morning. You're okay. Is this it? Good morning. You're watching this. Okay, good morning. You're watching a Business World Live. I'm Danie, Laurel. I apologize for the technical issues here. Let's see whether Jess, my co-anchor, can join me this morning. It's the start of a new trading day. Let's go straight to our top story, guys. The government is considering issuing bonds linked to the country's gross domestic product, or GDP. The Financial Stability Coordination Council, or FSCC, which is headed by the Bangko Sentral, Governor Ben Diokno, said their objective is to redeploy liquidity that is already available in the market to address risk aversion, as well as to move further toward the so-called new economy. Diokno said the GDP-linked bonds, if issued, will have a longer tenor than the Treasury bills. Letran Graduate School Dean Emmanuel Lopez said the GDP-linked bonds will be both an advantage or a disadvantage. That's depending on the volatility of economic indicators such as unemployment, foreign direct investments, and inflation. A downward movement of these indicators may jeopardize the value of the bond share, Lopez said. However, he noted that an issuance of such bonds could stimulate spending and investment, which he says could create a, quote, semblance of normality and may ramp up GDP growth. RCBC chief economist Mike Ricafort believes a faster pace of recovery will provide higher interest rate returns. The economy. Okay, we are experiencing some technical issues, but I'm going to go ahead with the market report. Now, hopefully you can actually see my terminal here with me. I'm going to be waiting on my producers to flash that on the screen here. But the biggest story here, there you are, Jess. We're going to wait
right.
whether
and it's quite a morning we were having here, Dan. We're having quite some technical difficulties. But like you mentioned, we're going to have a quick look at what's happening on the market there. There you go with your terminal, Dan.
Okay, so we were discussing this ahead of the airing, Jess. So bondholders, and this is actually my chart here, have had quite the year this year compared to at least equities, even worldwide, and the peso as well. So I'm just gonna show you here how the bond return. So this one on your screen is a 10-year bond, and recall that the lower the graph or the yield, the higher the price there. It means you've actually gained from holding on to those bonds, which have now a lower interest rate compared to just last year. Now, this have handed investors around 19% of returns already this year. So if you had invested in bonds last year, you'd have gotten richer by 19% na sana. And the yield, as you can see here on the 10-year debt, is already mga 3% from more than 5% in March. And you've actually got a couple of stocks that have announced even more bonds that they're going to be issuing. You've got SM Prime, for example. They're going to be selling up to 10 billion pesos of fixed rate bonds. That's 2.5 and 5-year tenors, and you've also got Aboitiz Power with a filing now of 30 billion pesos in shelf bonds. So the initial will be 4 billion pesos. So expect a flurry of some bonds here, especially from our, the ones that are really going to be using that for building and capital investments. Now, I just want to go back to my terminal here and take a look at the peso. Now, this has also gone from strength to strength, and we've seen this actually, look at that, Jess, 48.070. And this, according to surveys from Bloomberg, they're looking at the peso going to as strong as 47.50 by the end of next year. This, according to Bloomberg. Recall that we've actually been one of the star performers in the Asian region. We've gone up or strengthened by 5.4% this year. Now, it's not all rosy when you talk about this, because according to Eugenia Victorino of SEB in Singapore, if domestic demand is far from a full recovery, the peso actually might get stronger, and that's because we have lower imports than expected, which are normally, helping us to accelerate the capital formation here, infrastructure, for example. So she does say that she even has a target of 46 pesos. So if you've actually invested, in the peso and in the peso strength, you would have seen quite some gains at least this year. Now, I'll take you back to the equities market here, especially our index. This according to June Tarobago of ATR Securities. You can see your index opening at 7163. That's a bit of a slide from what we were seeing, mga 7200 na last week. He says though that the index could climb to 8300 by the end of next year. So that's quite promising, especially since we've actually seen the valuations quite high so far compared to the 5-year moving day average. But he did mention that this might be okay, and that the market might be able to trade above the 5-year historical average, simply because the foreign funds, remember, they've been exiting the entire year. If they do come in by next year, that should help drive the valuations to 19 to 20 times forward earnings. But in the short term, so you've got ilang days na lang ba before the end of the year, Christmas. I don't know if anyone's still counting this. It's a exchange Christmas. But nevertheless, this week, a lot are expecting the price to be declining this week, especially as this, according to Phil Stocks, investors might be booking their profits ahead of the holiday season na. In fact, we've got average turnovers last week up by 10.4%. So a lot of interesting things, and we're going to be asking our analysts later on, Aaron Sai, more about the equity space, Jess.
But let's go into some specific stocks here. Dan, the NAIA saga is not yet over with another player on the table. What's the latest on that front?
Yep. So very quickly here, you've got PAGSS, so that's PAGSS, right? Airport Ground Support Solutions, who will actually be getting the first shot at a bid here for the NAIA rehabilitation, and this is according to MIAA General Manager, and this is actually going to be ahead of the San Miguel Corporation's bid should Megawide really lose its original proponent status. That recall that they still have a chance to actually appeal that. And meanwhile, MIAA General Manager said, this is to the Philippine Star, it has not yet received a letter of appeal or consideration from Megawide. But Megawide did mention that they're still very much determined and they will be submitting this soon. Megawide, meanwhile, down by 1.4% this morning to 8 pesos and 48 centavos. Now, let's move on to some broader economic data just as we cap off the year. We're still having quite some issues when it comes to unemployment. Jess, what is the ADB saying?
Okay, this time around, they are projecting that by the end of the year, around 2.1 million Filipinos would have actually lost their jobs this year. That puts unemployment rate at 8.5% compared to how we fared last year, which was at 5.1%, according to official PSA data here. Now, the 2 million Filipinos that are expected, or at least forecasted by the ADB, to actually lose their jobs, 389,000 would have actually dropped out of the labor force, while around 288,000 would actually look for work in other lower productivity industries such as agriculture, mainly agriculture, in fact. Now, according to the ADB, the reallocation of industries following economic shocks is normal, especially for developing countries like the Philippines. That is due primarily to a lack of social protection which forces actually the unemployed to transfer to lower productivity industries, including informal employment in low productivity services, like what I mentioned in the agricultural space. Now, the decline in employment among tradable sectors is pretty much noticeable as the global demand tempers. We have the likes of manufacturing and even transportation, but job losses, according to the ADB, is actually higher in non-tradable industries. So that includes construction, wholesale, retail, which amounts to around 500,000 people who've actually lost their job in the sector, as well as accommodation and food, with around 256 Filipinos losing their jobs, at least in that particular industry, as well as public administration. But there are other impacts of the pandemic here. That includes a decline in labor force participation, at the same time, a reduction in hours worked as well. But, there are already signs showing that the job market is already picking up. Of course, recall that unemployment peaked back in April. That was at 17.1% here, to around 7.3 million Filipinos losing their job. And then come July, that eased a bit to 10%, meaning around 4.6 million were actually jobless. And then, of course, lastly, we had just last October, unemployment eased further to 8.7%, to around 3.9 million Filipinos losing their jobs. So the question now is, what can further boost the country's domestic job market? According to the ADB, what's going to be key here is the government's infrastructure push. Of course, we do expect that to have a multiplier effect. At the same time, stable inflation, low interest rates, and availability of vaccines. But really, what's important for them is that companies actually and the government help upskill workers via education and training to actually make them more productive, at least as members of the workforce, even post-pandemic scenario. Then.
Okay, Jess, well, hoping na tuloy-tuloy na yung single-digit unemployment figures natin for the rest of the year. Now, we'll have more on the news when Business World Live returns. Stay with us.
Good morning, you're still watching Business World Live. I'm Delos Santos. Measures extending the validity of the 2020 budget and Bayanihan 2 are now just awaiting President Duterte's signature. House Appropriations Committee Chairman Eric Yap said the two bills have already been transmitted to the Office of the President. Bayanihan 2 provides 140 billion pesos worth of assistance to hard-hit sectors by the pandemic, as well as a 25 billion peso contingent fund. It is set to expire tomorrow. Without extension, the allocation under these measures will revert to the National Treasury. As for pending disbursements, the DBM reported about 110 billion pesos, which is yet to be released as of November 13 under the 2020 budget. For Bayanihan to Recover Swan Act, the equivalent amount is 38 billion pesos. The extension in budget validity is expected to help the government catch up on spending after projects were derailed by lockdowns that started mid-March. The economy has already seen a 10% contraction in the first 9 months. Now, Meralco announces no disconnections until end January next year for customers who could not settle their power dues. The power distributor said this is to ease the burden of consumers in coping with the pandemic. The move to extend the grace period was also done following a request by the House of Representatives. Meralco said about 47% of their customer base stands to benefit from this extension. Meralco says the no disconnection policy extension is expected to help their customers feel secure this Christmas season, now celebrated in muted ways due to the health crisis.
Now, the government expects inflation to be manageable in the next 4 years. The DBCC retains its inflation target at around 3% for next year until 2022. That's as well as for 2023 and 2024. The Bangko Sentral noted, though, that inflation rates for 2023 to 2024 will depend on how fast the economy will be able to recover from the crisis. The DPCC has lowered its GDP outlook to 8.5% to 9.5% of a contraction this year from the negative 6.6% forecast in July. Now, last week, the Monetary Board raised its inflation forecast for 2020 to 2.6%. That's on the back of a faster increase in food and global oil prices. Okay, guys, is it holidays yet? Definitely not yet for our traders. There's still exciting trades happening at the tail end of the year. But should we take profits or should we hold on to those positions? We have with us Aaron Saya, First Metro Securities. Good morning, A. Welcome.
Hi, good morning, Danie.
Okay, let's kick off with short term, okay? We have some vaccine optimism happening here, but that doesn't seem to be spilling over to our opening this morning because you also got, on the other hand, an expected surge in cases. Diba? Some are saying 4,000 per day is expected during this holiday season. So what's it going to be talaga until the end of the year?
Well, we have seen the market really bringing cheers, no, to we have seen the PSCI really bringing cheers to investors. As we know, we are only down 7% as of last Friday. We're only down 7% year to date, and we're already up 80% from March 19 lows. No, so this really a really strong rally. No, but again, we have seen recently that rally has been tapering. No, we have seen that strong rally that we have seen after the market broke above the 6,000 level in October. It's now really coming to somehow a halt, no? And we have seen that the prices may be stopping around the 7,200 to around 7,300 level, no? So I think I think now there's a really good chance now that there's a possibility that the market could drift lower in the coming session. So I think if we are talking about the year-end rally, or maybe the Santa Claus rally, I think we have just ended that. No, I think
Okay.
especially with the new cases that we are seeing now. No? And again, we are really cautious about these levels, especially on the valuation front, no, which might be a concern for others.
Okay, so ito na yon. Ito na yung Santa Rally. Too good, too good to be true if we wanted more than this. But let's move on, as you mentioned, to 2021. So very forward-looking and how to position there for next year. You mentioned that you're still seeing the valuations quite overvalued, but there have actually been some analysts that are saying that, wala pa kasi yung foreign investors and the foreign funds. And if they actually come in, it might be justifiable that we're trading up to 20 times PE. What's your thoughts?
Well, that might be the case, no. But again, at the PSCI at 7,200 is now at currently 25 times forward PE, And again, that 25 times forward PE is really very expensive by historical reference. Although, to be clear about it, I'm actually with the camp that believes that the market might be underestimating earnings for the next 12 months. Now, again, the forward PE is based on that forward earnings, forward 12 months earnings, which the market is currently estimating to still drop from what it was for the past 12 months. No? And again, the past 12 months was the time during which we were in the lockdown. So to expect that the market or the corporates would earn less in the coming 12 months, less than what it earned for the past 12 months might not be the case, no. So however, I perform some sensitivity analysis on it. Even if we adjust for that, no, even if we adjust for that, in my opinion, underestimation, and even if we allow some decent growth for 2021 and 2022 at 7,200 level, I think the PACI is still at a level that can still be seen and expensive. Not very expensive as where we are now, but still expensive. So I think caution is warranted at this level.
Okay, Aaron, what about the rotation of other cyclical stocks or even the movement from safe havens towards equity markets like bonds, for example? Do you see that the bond rally will be tapering off by next year and maybe people will be rotating their investments towards equities na rin? Or for example, from developed markets towards back to emerging markets, and this might actually sustain the 7,300 or above levels?
I think we have seen that rotation already to the equities market. Now again, that rotation has actually fueled the strong rally that we have seen not only in the Philippine market but also in other emerging markets. As we can see the charts of the ETF that is underlying which is the emerging market indices. Now it's actually revisiting its multi-year high at around 50 USD. No, so I think the interest now in emerging market equities is really increasing by the day. However, again, as we noted, no, the bond market has really been hot, no, especially this year, which was really driven by the continuous expectation of low yields moving forward. And I think there's really a case, especially we are in a recovery mode, unless the central banks or the policymakers would be willing to somehow choke the growth trajectory moving forward, no, which I think they would not. No, there's really a good chance that the yields would be that the interest rate guidance, especially from policymakers, would still be low moving forward. But then again, we have reached that low in the secondary market already. We have seen that the yields have been increasing. I think for the PH 10-year, we have increased from around 2.5 to around 3% already. No, so we have
Right.
increased 50 bips already from the bottom. No, and there's a really good chance that we could somehow retest the 3.16% level, no, 3.16% for the 10-year bond in the Philippines in the coming days, no, and that would actually have a negative implication for bond prices. So we see the stock market recovering. No, we see the stock market recovering. We are not seeing yet a very convincing recovery in the corporates, but we do expect that it would be better. I think if we compare the next 12 months compared to the last 12 months, no. But then again, absent any foot traffic in the malls or absent any significant changes in the consumer behavior, I think caution is still warranted. Caution, no, but still optimistic about the recovery, especially with the vaccine.
Okay, so you're saying that, in terms of market valuation and pricing, it's maybe already all the optimism has already been priced in. What about the downside risks when it's related to the economy, particularly on issues like the budget hopefully being passed na, and probably wala nang stimulus to be coming. They've been quite clear on that front. I mean, you've also got, I just wanted you to comment last on Finance Secretary Sonny Dominguez's he mentioned that when he was looking at the capital markets numbers from PSE President Monzon, it doesn't seem that the COVID-19 effect is such a big bump on the road for the economy. So he did mention already earlier on, it's not just fiscal stimulus that needs to be done, but we can actually recover with all of the things that we are already having right now. What's your thoughts on that, and how would this outlook of the government affect the investor sentiment next year?
I think absent the COVID situation, I think the Philippine economy is really on an upward trajectory. So the corporates, especially the big investors in those corporates, are really gearing up, or have been really gearing up for that, to benefit from the up move from the market or from the economy. So I think the COVID really derailed what these corporates are expecting. But moving forward, I think the market is now giving that optimistic outlook a second look now. No, however, it would be very difficult for it to be sustained absent any, again, indication of the reversal of the negative effects of the COVID. So I think the catalyst really here is the timing, no, the timing and the effectiveness of the vaccine that will be rolled early next year, no, or early to mid next year, and from there we can see whether really the COVID really has a very significant effect post the 2021 recovery stage.
Okay, so a lot of hope pero wala pa ring strong catalyst that still
Oo,
needs to actually be happening, but a lot of optimism nevertheless. Thank you so much for those insights, Aaron Sai from First Metro Securities, and see you next year.
Thank you, Dan.
And that's a first look into the business day. Today is Monday, December 21. I'm Danie, Laurel.
Catch us again tomorrow at 9:30 a.m. I'm Delos Santos. We are One News.